Good afternoon and welcome to the HBS Club webinar. Today we're going to be talking about our annual economic forum. My name is Edward Hughes. I'd just like to share a couple of slides with you as we get going here and talk a bit about the club before we introduce our guest today. So the HBS Club of San Diego is delighted to host this event. I want to thank our sponsors, City National Bank, Latham Watkins, Dowling Yankee, KPMG, Hughes Marino, and the Honor Foundation. Our mission as a club is very simple. It is to continue to educate leaders who make a difference in the world and make San Diego a great place to live and work. So as many of you kind of expected, we've had to go to a virtual schedule for the last year. And that's allowed us to actually have some really terrific programming. So, since then, we've been having a number of virtual events with Hughes Marino, with Chairman of Novacure, Professor Bill Salmon from HBS, Bill Ackman, the billionaire active investor from Pershing Square. We had the HBS Global Networking Night. We've had Kevin Sneeder, the Global Managing Partner from McKinsey and Company. We've had Robert Engel, Professor Engel, Nobel Laureate, Economics and Professor. We've had Laurie Hearn talking about, from the CEO of iNewsSource, talking about fake news and how to tell that it is fake news. We had a recent event with Hughes Marino where there's kind of an update on the commercial real estate marketplace in San Diego, in Southern Cal, and also in the US. Today, obviously, we have our economic forum, and we're very excited. Next month, we have Professor Frances Frye, one of the most popular professors at HBS, and she's going to be talking about some of her work on leadership and ethics. So the format today is going to be a panel discussion. It's going to be moderated by Amanda Montgomery and Gabriel Wisdom. Amanda is Director of Allianz Global Investors. Prior to that, she helped manage money for the City of San Diego Pension Fund, and before that, Morgan Stanley. Gabriel Wisdom is the President and Managing Director of American Money Management. He's an entrepreneur, he's a radio personality, he's an aviator. These two have hosted our economic forums for the last maybe 7-8 years, and a fantastic job. They're going to introduce our panelists. This event will be recorded. It will be available to members immediately afterwards, and 30 days later, we'll put this on YouTube for general consumption. The majority of the event today is going to be Q&A, and Amanda and Gabriel are going to do that, but we are going to invite, obviously, audience participation. So please type your questions into the question tab, and we're going to leave plenty of time at the end, hopefully, to tackle those. So as you think of things you want to ask, do that. I will moderate those questions at the end. So with that, let me turn this over to Amanda and Gabriel, and I will come back and join you guys in about 45 minutes.
Thank you, Edward, and welcome everyone. We are delighted to have the same three panelists we had a year ago this time back with us. So thank you so much, panelists, for joining us. And to all of you out in the audience too. I'm going to quickly introduce our panelists, and then we're going to get right into it because I know this hour goes by really fast. So I think we did ladies first last time. So Dan, we're going to start with you, the man who needs no introduction. We all know our San Diego County Treasurer and Tax Collector well. Dan's been in that role since 2002. He oversees a collection of nearly $7 billion in our property taxes, manages close to $12.5 billion in the county's investment pool, along with a $1.5 billion defined contribution plan. And if you haven't had the chance to go down to 1600 Pacific Highway and check out Dan and his team and the operation they run there, I can tell you it's one of the most impressive and progressive county treasurer tax collector operations in the country. So welcome, Dan. Thank you for joining us.
Thank you.
Our next guest is Dr. Nakia Clark. With a very, very impressive background. Dr. Clark is Vice President of San Diego Regional Economic Development Corporation, or EDC. It's quite a mouthful. She also wears a second hat as the Executive Director of World Trade Center San Diego. She sits on the National Investment Advisory Council, which is a collection of senior leaders that advise the administration on foreign direct investment policy and strategy. She's also the founder and former director of an organization called UCAN, if I pronounced that correctly. It's an international network of emerging market industry leaders, policymakers, and researchers. One thing that's not in her bio that I think is really interesting is she did some of her doctorate research in emerging market investment strategy, foreign direct investment projects, and did some extensive field work in China and Nigeria. In addition to speaking Spanish, she speaks Mandarin and Setswana. I think the only person I know who speaks Setswana. She is a graduate of La Jolla Marymount, has a master's in international development at Cambridge University, as well as a PhD in politics and international relations from Oxford University. Thank you for joining us, and welcome, Nikia. And last but not least is my colleague, Mona Mahajan. She's director and U.S. investment strategist at Allianz Global Investors. She is the only panelist not a local. However, she is a Harvard Business School alumni. She's a member of Allianz's Global Economics and Strategy team. You can find her and see her on CNBC as well as other news outlets. She's a key spokesperson, both internally and externally for our firm, out there talking about high conviction investment ideas and views from the firm's Global Policy Council. I will add, she has a long background in the asset management industry. She is not just a strategist, as Mona has also been a former portfolio fixed income manager and other hands-on investment roles. She has a Bachelor of Science in Economics from the Wharton School, in addition to a Bachelor of Science in Computer Science before attending HBS. So with that, I'm going to hand it over to Gabriel, and we'll stop talking so you can hear our esteemed panelists speak. Thank you.
Thank you, Amanda. All three of our panelists were here presenting to the club 1 year ago, just before the pandemic began. And of course, nobody could have predicted the historic year ahead. Before we get into where we are today and your forecast moving forward, could you briefly remind us what was your topic or your forecast for each one of you a year ago, and how did you pivot throughout 2020 as a crisis unfolded and evolved? No more than 5 minutes per panelist. I'll start from the rear here. Mona.
Sure, absolutely. Thank you, Gabriel, and welcome everyone. It's always great to be back at Harvard Business School events, even if they are virtual, but always great to be with alumni. So yeah, to your point, 2020 was a remarkable year in so many ways. Of course, we were battling a major health crisis, but from our perspective, we were also battling a major economic and even market crisis. I would say last year, some of the key things that we were thinking about, first from an economic perspective, then from a market perspective. In the economy, we were of course looking at unemployment rates and GDP growth. So, if you think about really what we were battling, we're facing after March or mid-March, a series of economic or quarantines and economic lockdowns, shutdowns, rolling shutdowns throughout the country, which really was the key driver for putting much of the economy on hold. And so what did we see from an economic perspective? Well, GDP growth in the first quarter last year was down an alarming -5%. In the second quarter of last year was down a staggering 31%. And these are quarter on quarter annualized GDP growth figures, real GDP growth figures. Those were numbers never seen before in the US economy. And so you could really kind of see the impact of a global pandemic from an economic perspective. Meanwhile, of course, when you looked at the unemployment rate, you also saw similar trends. Prior to the pandemic, we were looking at unemployment, really below trend at 3.5%. We spiked higher in unemployment to about 15% at its peak. And then after Q2 started trending somewhat better. Keep in mind, as these economic shutdowns were occurring and as the lockdowns were occurring and as GDP growth was stalling and unemployment rate was spiking, a lot of market participants were actually forward looking. And, we always say the market looks ahead 6 to 12 months. It was remarkable to see in real time. So from a market perspective, transitioning, to markets now, We, of course, saw the S&P 500 fall 34% in a 6-week period. So from February 19th of last year to really March 23rd at its low, the S&P drawdown was again, a remarkable 34%. But since then to the year end, we actually saw the S&P rebound nicely, 65% recovery. And of course, from a market perspective, what we were really observing is the dichotomy in performance if you looked one layer deeper. So while the overall S&P was up from March 23rd, when you looked at the sectors that were really outperforming, it was what we called those COVID winners. So there were some trends that emerged last year or really accelerated last year that drove market performance. So when you think about things like online retail, like cybersecurity, like the migration to cloud computing, even telehealth and telemedicine, all these trends that were slowly happening really accelerated through the pandemic. We saw those handful of COVID winners really thrive. And so their growth rates on a quarter-on-quarter basis started to improve. Of course, on the other hand of that equation, you had those laggards, those really hard-hit sectors that really kind of shut down through this pandemic period. And of course, those were travel and leisure, hospitality, what we call the value sectors, energy, financials, industrials, all took a major hit. So by the end of the year, what you really saw in 2020 was a dichotomy market performance between the haves and the have-nots, or the COVID winners and the COVID laggards, I guess you could say. And then finally, I will just talk about rates briefly as well, because that was a big story and a big driver. So, the 10-year Treasury yield, for example, prior to the crisis was close to 150 or so. It fell as low as 50 basis points during that March period and slowly recovered over time. But last year, we still remained largely under 1% on the 10-year. Of course, we also had a Federal Reserve that quickly stepped in, provided support, brought rates back to zero bound, provided liquidity into the system as well. So as we were heading into 2021, and I know we'll talk about this, we were looking at an environment where we had a supportive Fed, we had potential stimulus coming into the system through fiscal stimulus, and of course we had a potential now for a recovery year ahead of us. But 2020 was really a year of haves and have-nots, I would say.
Thank you, Mona. Now we go to Dr. Clarke. And Nikia, you can give your answer in the language of your choice. We prefer English, but
I'm going to go with Setswana. That always comes in really handy. I think actually Mona's comments set up what I was going to say perfectly, which is that this 2020 really was, we call it a sort of tale of two recoveries, a tale of two economies in metro regions around the country, and San Diego was no different. I was thinking about this time last year when we were doing a lot of these types of forecasting panels and events, and I was spending a lot of time talking about sort of with unemployment at 2.9%, what that meant for sort of talent development strategies and how we would fill all of these roles in the new economy. I was spending a lot of time talking about the fact that we had in San Diego County probably close to $30 billion of large real estate projects in the pipeline, mixed use development, a new sports arena, San Diego State University's Mission Valley development, Seaport Village, and fingers crossed the market stays strong because all of this commercial real estate we're going to focus on filling over the next year. And then lo and behold, the economy sort of went off a cliff and everything changed. And we were talking a lot about when the next correction would be, and nobody could have foreseen the type of correction it would be, obviously. But in that moment, so I work for the Regional Economic Development Corporation. We are a nonprofit that's private sector funded primarily by most of the big businesses in San Diego County. So most of the large employers invest in us to drive a broad-based economic development strategy for the region as a whole. And our main mandate is jobs, right? Prosperity and competitiveness, and focusing on strategic high growth sectors and figuring out how to make sure those companies can grow and thrive so San Diego stays competitive. And we work with and through sort of a coalition, we call them investors, but they're members in our organization of about 200 big companies, and then as well as public sector partners as well. And we work to lead programs and initiatives that are demand side driven, so really responsive to where the economy is at any one time, that are employer led, since that's our stakeholder base, and that are outcomes based, so that we can see the impact we're having. And over the last year, I think our team and the region has been stretched in ways we couldn't have really imagined. When everything shut down in March, and to Mona's point about it, kind of COVID winners versus COVID laggers, our mandate became sort of split in that way too. On one hand, San Diego is a life sciences hub, one of the top 3 in the country and even the world. And so we had a lot of companies that were sort of pivoting immediately to meet this moment and needed massive support with large scale expansions. They needed new manufacturing space for test kits. They needed other sort of supply chain second and third tier suppliers in the region to be able to pivot to meet their demands within the region when they were less able to get what they needed externally. And so at a time when like our development services department couldn't access its downtown office location, was in the middle of a digital transformation, and couldn't access its servers, and physically couldn't go in because of COVID and because of riots in the street, you had all of these companies that were saying, we need expedited permitting, we need more help, we need to expand, and if we're going to meet the health crisis the way we need to meet it for the sake of the world and the country, we need help. So we had a team that was deployed on that almost nonstop. And at the same time, you had businesses that were closing across the county, many across a number of sectors, and trying to figure out how to apply for fiscal or for federal dollars, how to keep their lights on, their doors open, how to pay their people, and what the sort of employment rules and laws around all that were. And so we had a team that we deployed really rapidly to do that. And the impacts were really sort of differentiated and very concentrated. So now, a year later, as we look at kind of the work of recovery that's ahead of us, that's still very true. So since about June, we've seen for sort of job classifications that are middle wage and above, $60,000 a year and above, that's been growing again since about mid-year, and we're well above where we were even when the crisis started in March of last year. And so a lot of growth in knowledge intensive sectors, and still some significant lack of high wage workers, right? So we're still doing a lot of work around talent attraction. And at the same time, we have sort of more than 30% of small businesses are closed now, and many of those are likely to reopen. That's a higher number than it was at the height of the crisis in March of last year when everything was closed. And small business revenues are way, way down, and small businesses in San Diego, like everywhere else, employ about 60% of San Diegans and make up about 98% of businesses. So there's a lot of work that remains. And again, you have this story of kind of 2 recoveries, and the needs of different businesses and the needs of different sectors and pieces of the economy are also very differentiated, which is an opportunity and a challenge, obviously, for an organization like ours.
Thank you, Nikia. Dan, how did the Treasurer Tax Collector pivot through 2020 as the crisis unfolded?
You know, it's interesting, as I look back on the issues and the subject lines that we were given last year to talk about, I couldn't agree more with the previous 2 speakers, because I think they were right on in terms of what they said. So in conclusion, let me just say I agree wholeheartedly. But I will tell you this, that we look at numbers from a lot of different places, particularly lately, Sandag. And one of the things that stood out to me was that 89% of job losses were in 3 industries primarily in San Diego: tourism, retail, and education. And that is a pretty telling number when you look at it and think about it. Last year's topics, though, talked to us in terms of strong employment levels, very low unemployment numbers, the local economic drivers, of course. At that time, we were looking at cruises in and out of the bay and the harbor on a regular basis. Now they're drifting offshore in the Northern California region, the LA region, and even here. We're still waiting for that to come back. The convention center was thriving and doing great work. Comic-Con was sailing high. Everybody talked about Comic-Con, and it really had gained in a lot of circles, a lot of national good press for San Diego. Federal spending seemed to continue, and construction. Both of those areas really did continue to pour in money into this economy. The federal dollars in particular, when you think about the monies that support our military and our huge military presence that's here, those paychecks arrive on a regular basis. That money does stay here for many purposes, but those are things we talked about last year. Low interest rates, of course, were there when it came to talking about the strong housing market. And we see some duplication now in that area, that arena. But we were starting to hear after we finished our discussion last year, more and more on a daily basis about this thing called COVID-19. Nobody really knew what it was or how it was or what a pandemic was, but we got the message very quickly, and people discovered worldwide that this was a very, very serious matter, and it has impacted economies throughout the world. We're not exempt from that, but some of those numbers are pretty staggering. You look at tourism off 52%, retail off 15%, education down 22%. Those are impressive big numbers. And we're in the process, as was discussed just a few moments ago, of trying to rebuild, trying to get things back on track, trying to make Comic-Con a reality again, trying to bring those things back to San Diego that were here just a year ago.
Thank you, Dan.
Thanks, Dan, and everyone. That's a great recap. And before we open up for questions, maybe you can each spend a little bit of time talking about what you're thinking about today, the conversations you're having with relevant stakeholders, and you all kind of agree on 2020. We'll see if maybe we can get some disagreement in your projections moving forward. Mona, can we start with you?
Yeah, absolutely. Yeah, look, just as 2020 was a year of shutdown, perhaps we're looking at 2021 as a year of real reopening. And of course, we're looking at some of the fundamental factors that go into that. We're seeing vaccine rollouts here in the US improve, especially from those early days where we were sub 1 million vaccinations per day. We're now towards 1.5 to even 2 million people getting vaccinated on a daily basis here in the US. We're looking at COVID trends that seem to have improved substantially as well over the last few weeks. And of course, we're looking at an economy that really is starting to return a little bit more towards normal. And just to put some numbers around that, in terms of the economic growth figures we mentioned, GDP growth, real GDP growth is expected to go from negative 3.5% last year to plus 5% in 2021. And keep in mind, 5%, while it may not seem phenomenal, it actually is well above trend growth here in the US, which is usually 1.5% to 2%. Those unemployment rate figures that we talked about that were, peaking at 15% plus have now come down to about 6% and are expected to be 5% or even sub 5% by the end of 21, early 2022. From a market perspective, we've also seen a little bit of a reversal. So we were talking about the COVID winners and the COVID laggards. Well, those laggards have really started to play some catch up here. And so, while it's early still, we're still in the first few weeks of 2021. But what we're seeing in the trends is that those value sectors, areas like financial, energy, industrials, some of those leisure and hospitality sectors that were really lagging last year are now the outperformers this year. So the S&P is up about 5% already year to date, but energy is up 30% plus. Finance, the financial sector is up about 13, 14%. When you look at some of the airlines, some of the hotel names, also double-digit plus type performance. On the other hand, when you look at the winners from last year, and really the winner over the last decade, which has been those growth sectors, the FANG names, the technology sectors that we talked about, those have been a little bit of the laggards this year thus far. And so I think it's an interesting reversal. And, value does get its day in the sun when you're going through a recovery period like we are. And so we're hopeful that this value trade, what we're talking about with clients is that start layering in cyclicality if you haven't done so already. Start making sure you have some exposure to the reopening trade, to small caps, to even non-US, just to complement your US positioning, because they could play some catch up. A lot of non-US businesses and companies are exposed to more value sectors than growth and tech like we have here in the US. Also, interestingly, and maybe I'll just end on the note that interest rates have started to climb back higher. And so I think it's interesting to get that 10-year. Today, we see it close to 140, so almost back to pre-pandemic levels. For a lot of sectors, that's helpful. Think about banks, they like higher rates. But for some sectors, it's not as helpful. So even areas like technology, areas like healthcare that tend to be longer duration, if you put higher interest rates, for them, it's actually a little bit of a headwind for growth. So what goes hand in hand with that is that we're also starting to look at inflationary pressures a little bit more. So if you have this true reopening in the second half of this year, where you get this pent up demand unleashed, and I think we've all heard stories anecdotally about how we're starting to book travel more, maybe starting to eat out more over the summer, that unleashing of pent up demand could also unleash some inflationary pressure. So it's something we're keeping an eye on in terms of a risk to the story. But overall, we'd say the backdrop is pretty benign. So growth is recovering. The Fed is still very accommodative. And of course, we have still signs of massive fiscal stimulus still to be unleashed into the system. So that's a pretty good backdrop overall for markets, for risk assets, for the economy. And so we're hopeful that remains in play. But, again, it comes down to sector performance as well.
Thanks, Mona. Nikia?
And maybe against the backdrop of kind of those market dynamics, and maybe I'll talk a little bit about sort of corporate decision making in this really unprecedented time. We've been doing a lot of surveying, both regionally, with our most globally facing firms. And then we also a number of executive interviews with about 35 of our biggest companies. And then we also pulled together what we called an HR forum. So it's the chief HR leaders from most of our very large companies to talk about sort of how they're grappling with some of the workforce and the return to work and the vaccination challenges of this moment. So we've done a lot of that type of intel seeking, I guess, over the last year to try to figure out what's going to happen. And what we're really keeping our eye on, we're seeing a lot from the companies that we talk to day in, day out, a lot of conversation around sort of the shift in the global calculus, right, in terms of a move from, or an acceleration of the move from really lean supply chains to really resilient ones. And a lot of firms kind of doing audits of their supply chains to figure out, I mean, COVID really revealed a lot of the vulnerabilities, and not just the global supply chain, but for companies individually too, sort of vulnerabilities that come from tier 2, tier 3 suppliers for really globally or geographically dispersed supply chains. So a lot of acceleration towards more regional models to serve regional markets, and shifts in kind of productive behavior that have been really interesting, and a lot of momentum there. Massive acceleration in trends around automation and around digitization, which isn't surprising to anyone, but big increases in corporate budgets towards a lot of that digital transformation. And that appears to be ongoing, which I think is interesting. And then so much conversation around kind of the future of work. And we were talking a little bit about this before we started the panel today, and what things will look like. What of the transformation that's happened over the last year, what trends are permanent and what trends are temporary, right? And companies being really all over the board in terms of how they're thinking about their return to work strategy. So obviously for manufacturers, for life science, for military and defense actors, they've been back in the office this entire time primarily, and have needed more space in which to do that same amount of work, which has impacted kind of commercial real estate trends here. But then for a lot of the tech companies that are in San Diego, they're not sure that they will be able to get their people back in when it's time to come back, and what that really will look like, how much of flexible work is going to stay and how much is not. So we have companies, I was mentioning before, a couple that have cut their global real estate assets by 50% already and just decided to go to a much more flexible, much more agile real estate footprint globally. And we have others that are planning to continue to expand their footprint and bring people back full time. And then finally, or actually rather also on the future of work conversation, a lot of companies really concerned about the impact of this COVID year on their workforce demographics. Most of the job loss in the United States at this point is women dropping out of the workforce, and obviously with schools closed, with childcare facilities closed for as long as they have been, there's been a disproportionate impact on women's labor force participation. And I think that is a trend that will be very interesting to watch as we move forward. And I know a lot of the companies that we talk to are looking at those numbers at the firm level and are concerned about what that means for their long-term goals around diversity and inclusion. And obviously, in terms of race and equity, that is a conversation that has become front of mind in an entirely new way. It shouldn't be that new, but for a lot of companies that are being much more intentional about building a workforce that's representative of the regions in which they work. And then finally, one other trend that I think is very interesting, because the US, unlike Europe and other places, instead of focusing on job preservation, they focused on sort of on direct cash transfers, and a lot of the jobs then went away here in the United States. There's been a big uptick in entrepreneurship nationally as a result. That's much larger than what you're seeing in Europe and elsewhere. So I think that's an interesting trend too, especially in a place like San Diego that does have a very strong entrepreneurial history. A tremendous number of small businesses have shuttered and a lot of jobs have been lost, but there seems to be a lot of innovation and movement towards sort of taking advantage of this new moment and not letting any crisis go without taking advantage of it. I forget what that saying is. Anyway, so those are the things that we are really looking at in the year ahead as being sort of levers of transformation or change for the regional economy and the stakeholders that we're talking to.
Thanks, Nikia. Definitely some interesting trends there. Dan?
Well, it's interesting too, when we look at consumer spending, we know it's way off. It's off 13% here. If you look at some of the numbers for airport passenger travel, off 71% domestically, off 89% internationally. These are areas that need a rebuilding, and reasonably quickly, or else there will be other consequences, I fear. It's interesting too to look at the reaction when there are stay-at-home orders. We see a consistent sharp decrease in foot traffic at malls and restaurants. Restaurants on again, off again, but definitely in the malls and the retail market. We're still down 1/3 in terms of foot traffic. And if foot traffic doesn't improve, we could see a crisis in commercial property because these businesses will permanently move online or close. Those are big issues. Now, the bright spot, we talked a little bit about this in a housing market that seems to know no cap. It just keeps running up, thanks to the interest rates and thanks to a supply and demand theory that seems to work for a lot of people who are sellers and wanting to move the properties. But you'd normally see home prices drop during a recession. That isn't the case here. But a big factor is that the mortgage rates continuously have been reasonably low, and it allows people the opportunity to buy something that they otherwise wouldn't have been able to pay for previously. So good or bad, that's happening. One of the things that we look at, and Gabe asked this earlier, I wanted to make sure we addressed it, and that is from a tax bill standpoint. This year we mailed out over 1 million secured tax bills in San Diego County. Our total take, if you will, and the amount we will expect to get back as a result of those bills is $7.27 billion. Last fiscal year, the pandemic affected our collection rate somewhat, but when you look at the previous 6 years, we were over 99% collection rates. Last year, we pushed a little bit lower than that, but ended up at 98.65% collection rates. And this year, we are ahead of last year. So we see good things happening where collections are concerned. And people in San Diego never fail to amaze us because they stand up for what is owed, they pay what is owed, and they do it on time. And we've seen that time and time again. But this year, we're hopeful of finishing the year somewhere at the 98, maybe even a little bit higher percentage for those tax dollars that are so vital to supporting the lifestyle, but also the services that are provided by government throughout San Diego County on a regular basis. First responders, there are any number of other good places those monies go, and we need to continue that flow. But right now we've collected 59% of our property taxes. And of course, you all recognize that the second season of giving is almost upon us. That's April 10th. So taxes are due, just note that. But one positive outcome for us of the pandemic, and I think this is kind of interesting to talk about, and that is that our online payments, the electronic payments we get, are up 5% over last year. So we hit now 65% for all property taxes being paid electronically, and that's a new high for us. Our mission, of course, is to continue to grow that and be as efficient as we can in collections. But I think that overall, if I'm asked, as we have talked a little bit about what do we see and what would be a good way to brand this year, cautiously optimistic. Sounds a little cliche, but when you think about it, COVID is not yet taken care of totally, but we're seeing some vaccines that have worked some magic and done some good things so far. And with that program expanding, we should expect good things and a lot of optimism. Market stability. We've seen lows. We've seen some interest rates that don't even parallel anything that we grew up with or have known in the past. They're still out there. One need only to tune into any radio station and hear 5 commercials for loan brokers on a regular basis. And that's a sign that there is a lot of activity in that financing and refinancing arena. But tourism coming back to San Diego is something that we would look forward to seeing. We're optimistic about that. And when you think about employment issues, seeing blue collar jobs come back as more things reopen is something that we are optimistic about. But permanent change to teleworking is something that is out there, and it's something that as a result of the pandemic, I think will be more and more discussed in months and years to come, because people have found that they don't need necessarily to report to an office every day downtown. They don't need to dress up for work every day to go to that office downtown. They don't even need to drive downtown. The spare bedroom that was left when their oldest son went off to college or daughter is now an office. And they're making hay while the sun shines or doesn't shine, and things are working in that regard. So I think that maybe the impact there, negative impact, might potentially be commercial real estate if there isn't a proper plan and a process in place to figure out what to do with those empty corridors and empty office spaces in downtown and around.
Yeah.
I couldn't agree more, Dan. I just said earlier, I'm not going back. Don't tell Mona.
I'm with you.
Okay. Well, Gabriel and I have no shortage of questions, but we want to throw it out to the audience, and maybe over to you, Edward, if you have some questions that have come through in the chat.
Sure, and I'll try and group them. Let's talk a bit about government and stimulus. So you guys didn't talk a lot about that, and maybe I can start with Mona. Obviously, there's a third round that's about to be negotiated and put out there. how effective were the first two rounds? What do you feel about this round? The Wall Street Journal yesterday said that 800 billion of the 1.9 trillion is actually, related to COVID, and the rest is not. So maybe you can talk a bit about what you think about the stimulus packages and the new one that's on the way.
Yeah, absolutely. Look, this $1.9 trillion stimulus package, first of all, it's a phenomenal amount on top of 3 prior packages, which now total close to $4.5 trillion, if you do include this 1.9, and that's roughly 30% of US GDP. And so compared to a lot of the globe, the US has really put a lot towards stimulus. And the goal of that stimulus, of course, is to provide a bridge for the economy until we get to that true reopening. And, some people would argue we're starting to get there even without all this stimulus. But what I will say about this $1.9 trillion package, it does seem that the Biden administration is very, gung-ho on getting something through the system, and something that's in a large size. So ultimately, I think the 1.9 trillion was met with a Republican counter offer of close to 800 billion. I think ultimately we'll get somewhere in the middle with probably 2 to 1.4 trillion over the next few weeks. So this is probably going to get pushed through probably by the end of March, maybe early April at the latest. But interestingly, the components of this stimulus package are probably threefold. The first is getting those who need the most help some help. So we have the direct checks to individuals, also increased unemployment benefits. The second part is probably more around state and local government, and there's a bit of controversy around that, but the argument is that state and local governments need the help, not only to support some of their ongoing programs, their lack of funding, lower revenues, but also to support schools and to support the vaccine rollouts. And then the third component, as you noted, and it is probably a third or less of the bill, is actually supporting federal vaccine rollout programs, testing, et cetera, et cetera. And so, we do think that the amount of stimulus that the U.S. has put through, and keep in mind, we just passed an $800 billion package just a few weeks ago at this point, it has yet to kind of flow through, a lot of the payments and the monies that are tied up haven't yet been deployed. And so we do think if this next stimulus gets passed, it will provide another boost to the economy. And in fact, when we talk about inflationary pressures, we certainly have to think about the amount of stimulus, the amount of liquidity that's entering the system. Of course, if you have people getting direct checks, how are they going to spend it? It could go right back into the economy, could go right back into the stock market, but certainly we'll start to keep an eye on where the bubbles are forming. But for now, I think the hope is that we do get that bridge, and it's important to get the economy back to where it was pre-COVID, but just keep that in mind that obviously could be inflationary, and we're seeing that in the market reactions as well.
Okay.
Amanda and Edward, we've got 5 or 6 questions from the audience. Should we? We've only got 18 minutes left. Should we get to some of those?
Yeah, there's one, probably Nikia, you're in a great position to answer this one. Talking about the exodus of businesses from California. What does San Diego need to do in 2021, 2022 to maintain its competitiveness as an attractive place to do business?
Yeah, so, I mean, that's the $1.9 trillion question, isn't it? I guess it's interesting from sort of where I sit as an economic development professional these days, to think about kind of the common logic of economic development, which for a long time was around sort of creating the right incentive structure to have companies relocate or establish in your area. And then that changed pretty significantly over the last 5 to 8 years, especially in a really knowledge intensive place like San Diego that's also high cost. And has high regulatory costs, to very much a talent development and attraction strategy, right? So what we heard from every company that we worked with was that like the data that they wanted was on how many STEM graduates we were graduating, on how many engineers we had in the region, on sort of what difficult problems companies here were solving. And that has very much become our business our corporate attraction strategy. If you have the smartest people in the country, then the companies will follow. I think one interesting question at this moment, though, is if it doesn't matter if your people are located in the same place as your headquarters, where do you put your headquarters? And I think that's kind of what a lot of companies are thinking through right now. You still have the best talent pipeline in the country, or one of them, here in California, and you still have sort of the, when you look at kind of the future focused industries, what technology, artificial intelligence and machine learning, a lot of sort of defense and aerospace future focused industries, the life sciences full stop, all of those have massive hubs and a lot of history in California and really smart people solving those problems. So, so it'll be really interesting to say. My gut sense is that you don't go wrong in a regional economy if you focus on the fundamentals of that regional economy. And if you look at what those fundamentals are, they're always they're jobs and talent and thriving households, right? I think that the cost, sort of the cost of living issues in San Diego and across California continue to be a massive challenge. And as Dan pointed out, like the cost of housing has only accelerated during this crisis period when a lot of people were losing their jobs. And so I think there are a lot of, from at the metro, the county region, and the state region, a lot of thinking that we need to do about how to ensure that more people are able to thrive here, not just because businesses might leave because costs are too high, but also because, to the point about the winners and the losers in the region, we're in a moment now where, like every other recession before this, the knowledge intensive sectors and the innovation sectors are leading us out of it and recovering much more quickly. But you've got about 30% of the population that are being left further behind. Low wage work is still 30% below where it was a year ago. You still have high levels of unemployment. If you look kind of at the census tract level instead of the regional level, a lot of that is still at like 15, 20, 25% in certain parts of the county. So I think looking at those fundamentals is really important. Like, how do you ensure that we're focused on job quality? How do you focus on, or how do you ensure that we've got the transportation infrastructure and the housing stock that enable people to thrive here? And that those people have an opportunity to find jobs, the jobs that the economy needs them to fill, and we know what those are. And I think if we focus on those fundamentals, San Diego will continue to be a competitive place. And I know people love to talk about all the companies leaving California, but we create double that every year. The ones that leave, we create, twice as many every year. So I think we'll be okay if we focus on the fundamentals.
All right, Dan, I got a question for you. So there's obviously the acceleration of the trend for people to buy stuff online, stream, etc., is having an impact on the retail real estate space. What impact does that have for you in terms of real estate tax collection? I don't know what percentage is coming from housing versus coming from retail type individuals, but obviously you're probably seeing some kind of shift.
I think it's a little early still to see that shift because this is so new as a concept. But I do think that the majority of our dollars roll in from housing as opposed to large buildings. But nevertheless, those buildings will continue to be taxed whether they're occupied or not at this point. And I think that the assessor will be doing some inventory, if you will, work to make decisions as to where things go and where things head. I think there's still a blurriness out there to this whole concept. I shared earlier when we were chatting before we started today that I had heard a report on CBS this morning, which is the first time I've heard this publicly, and that was that certain people are starting to look at buildings, high rises, commercial buildings as a source for affordable housing, potentially, and converting those buildings to affordable housing as one, for instance. So I don't know. I think it's a little early to understand this whole thing, but as Amanda said, it's on the top of a lot of people's minds, and it's going to require some good planning and some good thinking about what our needs are long term and where things work the best.
And a kind of follow-on question to Mona's on the stimulus relating to you, Dan. You said obviously that tax collections are going pretty well, and I think it's holiday or gift giving season coming up to you again soon. So there's part of this new stimulus package includes some state and local tax kind of help. So I'm sure you're always welcome to like to receive the money, but it sounds like things are actually pretty good on the local level.
Well, I think we always we're vigilant because we know we have a responsibility to collect those taxes on a regular basis. And that's what we try to do. We know that if the taxes aren't collected and they aren't paid, it can cost a lot of services that are vital services to each of our communities. There are 18 separate cities in the county of San Diego, and each and every one of them derives a certain number of tax dollars back based on a pro rata share. And it's important that those funds get used for the purposes they were intended. And first responders are right up there with all of them. And we need them, and we need their help.
Okay. Mona, there's a question relating to how should investors think about blockchain cryptocurrency as a potential new asset class and or allocation?
Yeah, that's one we've been getting a lot as well. And obviously, looking what the Bitcoin and some of the Ethereums out there have done, I mean, the performance has been phenomenal, even despite the pullback we've seen this week. Generally speaking, still as a firm, we are saying that Bitcoin remains a speculative asset class, and we've actually actively had portfolio managers inquire with our own compliance teams and risk management teams if there is, a change in that policy. But we're still at a point where, we're early in the use of what the Bitcoin can do. It hasn't been proven as a form of currency yet, and so very much keep it still in the speculative basket. Keep in mind, the pros are, of course, there's a phenomenal underlying technology, the blockchain technology to a lot of the Bitcoin assets that probably does have a use going forward in the banking system to some capacity. But on the other hand of the story, there are headwinds, and those headwinds include increase in competition, regulation. Keep in mind that I think the Chinese are out there trying to, create their own form of digital currency at this point. And so, what we say generally for investors is if you have a speculative basket, usually sub 5% of your portfolio, this certainly fits that. And, keep in mind, this is a volatile asset class. It will, move up and down in 10% plus increments on a daily basis some days. And so it certainly can be part of the speculative basket. Personally, I do see a lot more adoption from institutional players now. And so I think you're starting to hear more and more, including Square last night talking about investment in Bitcoin, Tesla, of course, a couple of weeks ago talking about investment in Bitcoin, some large, investment funds seriously contemplating more investment in Bitcoin. So it's becoming more institutionally owned and adopted, which is a good sign longer term. For us, we still maintain as a sub 5% category and something you should keep in the speculative basket, but something we're certainly keeping an eye on going forward.
Okay, good. I think we're pretty caught up with the audience questions. Let me cede that time back to Amanda and Gabriel.
Well, I've only heard someone say bubble once. You said it, Mona, but as you look out 2021 and maybe even beyond, what begins to concern you in the way of valuations and places, and Dan, from a housing perspective in bubble-ish territory?
Yeah, and also the moratorium on foreclosures is going to expire this year, supposedly. What happens when debt becomes due? We have a wave of foreclosures. Mona?
Well, I could start by saying that foreclosures are something that the industry is looking at very closely. And I know that a number of economists are looking at it as well. It's not something that people want to have happen, but it sounds like it's evolving to a potential market for foreclosed properties at some point late in this year or next year. At least that's what several economists have opined. I don't think in San Diego right now, when you look at $730,000 for a single family detached home, the highest ever on record here, this number just keeps going up. 13% increase last month alone in San Diego County.
Is that a bubble?
I hate to bring that up, but since our friend brought up the term bubble, it could be. But I know that there are those who say that the canary in the coal mine at the last recession were rooted in Southern California real estate. But I think it was a different time and a different set of situations. I just would hope that we would forge more people working together to solve these problems, as opposed to isolation problem solving in the future. There are still an awful lot of people on the bubble, if you will, or in the bubble, and they're barely making it. And they're on the verge of being left behind, and we have a responsibility there. So there needs to be some balance struck, and there needs to be some teamwork brought to bear to solve problems. And I think that the agencies that are working hard and the elected officials that are working hard on these things are trying their best to do that. Bring people together, solve these problems, get us back on our feet, and move ahead economically. As far as the housing prices go, anybody's guess. As long as the interest rates stay as low as they are, make no mistake, people are going to continue to buy.
Right. Amanda, did you want to find a new phrase or theme for?
Well, Gabriel, let's stick on our bubble a minute here, because I think I know Mona had a comment.
Oh, good.
Or some things
Oh,
to add.
yeah. No, just briefly, look, I think when you throw so much liquidity into the system and you have interest rates low for such an extended period of time, it's going to be natural to think about bubbles, especially asset bubbles. And we've certainly been seeing the stock market accelerate. I think just today, the Dow closed at an all-time high. S&P and NASDAQ have been there as well. It's interesting, Jerome Powell has been asked consistently about this question as well, because he's somewhat being accused of, continuing to spark the bubble with keeping rates low and at the zero bound and adding liquidity himself to the system. But it's an interesting response that he gives. And to Dan's point, it still remains a K-shaped recovery in some ways. And those people that actually own assets and own stocks are continuing to do well, but the rest of the economy, and there's 40% apparently of the economy that doesn't own stocks actively, and they may not be doing as well. They may not be homeowners as well, so they don't have this asset ownership that is allowing them to participate in the recovery and in this asset inflation. And so I think Powell talks about this a lot too, but he would like a broader based recovery, not just this K shape that we're seeing. And so what I would look for, and to your point about where do we see concerns or risks going forward, one risk is, of course, that the Fed does put its foot off the gas and starts thinking about raising rates again, or starts thinking about withdrawing some of the asset purchases they've been doing on a monthly basis. From a market perspective, historically, we enter bear markets when the Fed starts raising rates again. So we're watching very closely at Fed speak generally and what Powell and team have been saying. Thus far, they're showing no indication of this, and I think through 2021 they'll continue to remain pretty accommodative. Perhaps towards the end of 21 we start maybe seeing a shift in tone, especially if we get some of those inflationary pressures come through. But until then, I think from a market perspective, it's a pretty benign backdrop still. But that's the biggest risk. The second one is a rollover in growth. We still haven't probably reached peak growth because we have not yet seen the peak reopening. But when we get that inflection point in growth rates as well, it could be an indicator or at least an inflection point for markets as well. So two things to watch. But generally, I think everyone wants to see more participation in the recovery.
Great, thanks. Gabriel, did you have a follow-on question?
Yes. We last time with this panel, Amanda, we asked each panelist to give us a phrase or a theme to sum up 2020. I don't remember what some of them were, but this year maybe it's I'm biding my time, the new old normal. I'm staying home permanently. Give us a phrase or a theme in the remaining 1 minute. This is going to be just very quick to sum up your outlook for 2021. Mona?
I'd say the unleashing. So the unleashing of pent-up demand, the unleashing of stimulus.
Okay.
The unleashing.
Nikia?
I'm going to say the right recovery, and to the point about making sure prosperity reaches more people, and so the economy recovers and is more resilient going forward. I think that's the keywords for this year.
Okay, thank you. Dan?
Shared recovery. Shared recovery, cautiously optimistic. We're hopeful, and we want to see good things happen, not just to San Diego or California, but to our whole country. And the way to do that is to work together, bring people together, and make good things happen. And I think we will.
Well said by all of you. Well, I know my pent-up demand cannot wait to be unleashed. And I just bought my first tickets to New York City in May.
Oh, excellent.
So bring it on. I hope all of our listeners have pent-up demand waiting to be unleashed as well. And I hope better things lie ahead here in 2021 than the extraordinary year we had in 2020. Thank you so much to all of our panelists. Gabriela and I are so appreciative, and the club as well. Edward, I'll turn it over to you for any final comments before we wrap up exactly on the hour.
There you go. Perfect timing. Great. Thank you, everybody, for participating. This was great series of discussions and points. Thanks for the audience for participating. I hope we'll see you at next month with Professor Fry. Should be a great event as well. So with that, we always like to finish on time. And so thank you, and we will see you soon. Okay. Take care.
Thanks, everyone.
Thank you.
Thank you.
Great, thank you.